You walk into a bank. You deposit $1,000. You feel good, responsible, secure. Now, here is what the bank does next. It lends that money out, not some of it, most of it, to someone else, while still telling you your $1,000 is sitting there, ready whenever you want it. That is not a glitch in the system. That is the system. And once you understand how it actually works, you will never look at your bank account the same way again. Let us start with something most people assume but have never verified. When a bank gives someone a loan, most people imagine the bank opening a vault, pulling out physical cash that someone else deposited, and handing it over. That is not what happens. When a bank approves your loan, it does not move existing money. It opens a spreadsheet, types a number, and that number becomes real money, spendable money, money that did not exist 60 seconds ago. The Bank of England said this directly in 2014. Not a conspiracy theory, not a fringe economist. The actual Bank of England, in an official quarterly bulletin, wrote that the majority of money in the modern economy is created by commercial banks making loans. Most people have never read that sentence. Most people were never meant to. Here's how the mechanics work, and pay close attention, because this is where it gets genuinely strange. Banks operate under a system called fractional reserve banking. The idea is simple. Banks are only required to keep a fraction of deposits on hand. The rest they can lend out. For decades, the reserve requirement in the United States sat around 10%, meaning for every $100 deposited, a bank could lend out 90. But in March 2020, the Federal Reserve did something almost nobody noticed. They dropped the reserve requirement to zero. Zero. There is now no legal minimum amount that American banks must hold in reserve against deposits. None. Now, technically, there are other capital requirements and liquidity rules. Banks are not completely unconstrained, but the symbolic and practical meaning of that number is significant. The floor was removed. Now, let's follow the money, because this is where it multiplies. You deposit $1,000 at Bank A. Bank A lends $900 to someone buying a used car. That person pays the car dealer deposits $900 at Bank B. Bank B now lends out $810 of that, which gets deposited somewhere else, which gets lent out again. By the time this chain completes itself, that original $1,000 has theoretically generated several $1,000s in circulation. This is called the money multiplier effect. It is real. It is taught in economics classes, and then the class moves on without asking the obvious question. If money can multiply like this, who is actually on the hook if it disappears? Here's the uncomfortable part. This system works perfectly as long as everyone does not want their money at the same time. And for most of history, most of the time, they do not. So the system hums along. Loans get made, businesses start, mortgages close, the economy grows. Everyone nods. But the model is built on a shared agreement that nobody examines too closely. The moment people start examining it, the agreement starts to crack. That's called a bank run. And it doesn't take fraud or corruption to trigger one. It just takes enough people asking a simple question at the same time. Is my money actually there? In 2008, that question got asked about mortgage-backed securities. In 2023, it got asked about Silicon Valley Bank. The bank hadn't done anything dramatically different from what banks always do. It had lent money out. It had made bets. And when depositors got nervous and wanted their money back simultaneously, there wasn't enough to go around. The FDIC stepped in, crisis managed, normal service resumed. But nobody changed the underlying architecture. Here's the part that should make you pause. Every dollar created through lending is created with interest attached. The bank expects more back than it put out, but the extra money, the interest, was never created. It doesn't exist yet. It has to be borrowed into existence by someone else, which means the system requires perpetual borrowing to function, not as a bug, as a feature. Debt is not a side effect of this monetary system. Debt is the engine. And this raises a question that very serious economists argue about, and very few politicians want near a microphone. If all money is created as debt, and all debt requires interest, and interest requires more borrowing, where does it end? The honest answer is that it doesn't end cleanly. It either inflates, or it restructures, or occasionally it collapses and something new gets built on top of the rubble. So why does nobody talk about this? Some people do. Academics write about it. Heterodox economists argue about it. The occasional documentary surfaces and gets watched by a few 100,000 people and then disappears. But it never becomes a mainstream conversation because the system works well enough for enough people that questioning the foundation feels academic, theoretical, unnecessarily alarming. Also, the people who benefit most from the current architecture are the same people with the loudest microphones and the most expensive lobbyists. That's not a conspiracy, that's just how incentives work. The banks didn't invent this system in secret. Governments blessed it, regulators shaped it, economists modeled it, and for long stretches of time it produced real growth, real jobs, real prosperity. But there's a difference between understanding why a system exists and pretending it's something other than what it is. Your bank is not a vault. It's a machine that converts trust into numbers, and those numbers only mean what they mean because enough people agree not to look too closely at the same time. So here's the question worth sitting with. If money is created by lending, and lending requires belief, and belief requires not asking too many questions at once, what exactly are you holding when you check your balance?